Good afternoon. Dear clients, colleagues, and friends, welcome to the webinar about permanent establishment tax audits across Europe. Let me first introduce myself. I am Joan Hortalà, a partner of the tax practice area of Cuatrecasas, based in Barcelona. Today's webinar is the result of a joint effort of 8 European law firms. You can read on the slide. So it's Arendt and Medernach in Luxembourg, Arthur Cox in Ireland, Chiumenti in Italy, Cuatrecasas in Spain and Portugal, Gilles Loiret-Noël in France, Gleislutz in Germany, Homburger in Switzerland, and McFarland's in the UK. The 8 have developed an non-exclusive network in order to cooperate on joint projects to strengthen our ability to provide seamless integrated services to clients in complex cross-border transactions, international projects, and tax litigation. The permanent establishment is nowadays one of the hottest topics within tax audits across Europe. In fact, the PE concept has significantly evolved in the recent years. The enlargement of the concept was firstly challenged by the Italian tax authorities at the Philip Morris case in the early 2000s. Afterwards, Spain also pushed forward its boundaries with cases such as Dell or Roche Vitamins, ratified by its Supreme Court in 2016. Finally, and most relevant, the last OECD Model Tax Convention update has revisited this concept, and its new Article 5 wording has been introduced in the MLI, the multilateral instrument. So the reason to invite you to attend today's webinar is to share with you our experiences when we have faced this challenge in front of tax auditors. We have organized it in 2 sections. The first one, where Ashley Greenbank, partner at McFarland's in London, Raul Angelo Papotti, partner at Chiumenti in Milan, Fintan Clancy, partner at Arthur Cox in Dublin, and Olivier Daucher, partner at JIT in Paris, will discuss the topic from a pan-European perspective for about 30 minutes. Afterwards, we'll ask you to select one of the breakout rooms to follow a country-specific approach. Once finished, you will be back to this main room and be able to choose a second session on a new breakout room. Let me finally introduce 2 small technical tips. First one is, please do not turn on your camera. And secondly, notice that you may send us your questions through the chat icon on the bottom of your screens. We will do our best to answer them live, but most probably we would send you an email in the coming days answering your questions. Let's start now. Ashley, the mic is yours.
Thank you, Juan. I first have to say I'm glad to see that by the number of participants on here, we've still got so many European friends. This section, Juan, could I have the first slide, please? This section will set the background to some of the discussion that will follow, and I'll try to set out some of the legislative and treaty framework. So this part is going to necessarily be generic. You'll spot along the way that I'll make a few UK-centric comments and examples, but I'm hoping not to steal the thunder of my colleagues in the UK breakout session that's going to follow. We're going to try to address 3 key questions. Why should we care about permanent establishment risks? What should we do to identify those risks and evaluate them? And then when to get help and what sort of help. I've got 10 minutes to get through the first 2 of those, so we better crack on. And Ryan, could I have the next slide, please? So this slide is just an outline of the issues that we're going to try to address in the next 50 minutes or so. And starting with sort of why should you care? Well, as Juan has said, that the permanent establishment test is contained in many domestic laws and double tax treaties. And it represents the basic threshold to determine whether a business based in one territory has a taxable presence in another. But the world is changing, and so is our concept of taxable presence, whether that's changes to domestic laws to extend taxing rights to new income streams and activities, whether that be to reflect different ways of doing business, such as digital services taxes, or to address perceived abuses of the international tax system, such as the diverted profits tax in the UK. The treaty framework is also changing, as Ryan has said. Action 7 of the OECD BEPS process focused on the abuse of permanent establishment definitions, and the treaty changes that it recommended and has incorporated through the multilateral instrument provides with an expanded definition of permanent establishments, which, where it's adopted, allows these extended domestic provisions to operate. The international tax network may of course change because of other initiatives from the OECD in the next few years, but for now the permanent establishment definition remains the key dividing line. And that definition is under pressure because of changing business models. We've talked about increased digitalization of business, but also new ways of working, largely accelerated by the pandemic, which can result in the dispersal of key people within the business across jurisdictions, creating potentially taxable presences in multiple states and jurisdictions. It's also under pressure from governments and tax authorities who need to increase their revenue, and they're assisted by increased tax authority cooperation in a way unprecedented before, including automatic exchange of information, which provides them with new sources of information, not just tax related, but also other sources which tax authorities are using these days, financial reporting, beneficial ownership registers, all that kind of thing, and backed up by increased sanctions in both civil and criminal. So what should you do? Well, the thing to do is to try and understand the risks within the context of your business, and I'll come on in the next slide or so to look at how we identify permanent establishments. And when to get help? Well, my colleagues on this panel and in the breakout groups will then come on to talk about the practical steps that you can take, whether that is in relation to your past liabilities, adopting particular means of dispute resolution, domestic litigation, arbitration, both domestic and cross-border, making use of settlement facilities. In the UK, we have the Profit Divergence Compliance Facility, which I referred to on the slide. And for the future, well, reorganising your activities is one, but also trying to get some certainty for your transfer pricing through advanced pricing agreements and the like. Next slide, please, Joanne. So I said the first step is to try and evaluate the risk, and that means sort of finding your PEs, if you like. So let's look at the basic permanent establishment definition. So the scope of a country's taxing rights is, of course, a combination of both the domestic law provisions, which set out the prima facie scope of the taxing rights, but then they're regulated, if you like, by in relation to treaty countries by the operation of double tax treaties. But also many countries' domestic legislation has a provision similar to the OECD model, which adopts a definition of permanent establishment or something akin to that. The UK, for example, has a provision which is broadly based on the OECD model definition in Article 5. And that has two limbs. First, fixed place of business, the bricks and mortar, where a business is carried on. And secondly, dependent agents. So an agent acting on behalf of the company, which has or habitually exercises authority to conclude contracts in the name of the company in the source state. Some treaties you'll find have a third concept of a services PE, and this is usually where an enterprise in one territory performs services in another territory through one or more individuals for a defined period of time. And that is typical, that's found, for example, in the UN model, but you'll also find it often in treaties with China and with India. Next slide, please, Joanne. So what are the key risk areas? And I'm going to start with the dependent agent limb of the definition. And the MLI has made some material changes to this definition. The first key change to the dependent agent rule is to address commissionaire and agency structures which rely on not having a person with authority to conclude contracts within the particular territory. And the MLI extends that concept to cases where an agent plays a leading role in the conclusion of contracts, or a material element of the negotiation, if you like. But of course, it still only applies if the contracting states make that amendment through their ratification of the multilateral instrument. And for example, the UK does not adopt this change in its ratification of the multilateral instrument. But the expanded definition of in the MLI increases the risk that dispersed decision makers will give rise to permanent establishment risks in jurisdictions, and those risks can no longer be managed simply by restricting their authority to conclude contracts. The second element of the, can I stay on the previous? Second element is, of course, fixed place of business. And this has to have a degree of permanence, both in terms of physicality and in time, but it's not limited to the ownership of premises. It's the availability of premises to a business that matters. And so in appropriate circumstances, we've seen circumstances where tax authorities are arguing that, for example, a home office or a holiday home where one of your key decision makers happens to be for a long time could constitute a PE. I've talked briefly about services PEs before, but you need to find your relevant double tax treaties there, and also then whether there are individuals providing services over a material period of time in that relevant jurisdiction. Around the next slide. We should then take a quick look at the defences to the creation of permanent establishments. In the old form Article 5, there's a specific list of functions which are treated as not giving rise to a permanent establishment, and they're mainly dealing with storage and the display of goods and things like that. And then there's a general exclusion for activities of a preparatory or auxiliary nature. Now, in the changes in the MLI apply to limit those specific activity exemptions, essentially by making them all subject to the proviso that they meet the preparatory and auxiliary tests. And on the slide, you can see some of the features which you have to sort of need to decide whether or not an activity is preparatory or auxiliary. But essentially, it's a question of whether or not that activity is integrated, or the extent to which it is integrated within the profit generating activity of the enterprise as a whole, and how peripheral it is to that key profit making activity. The second MLI change is to prevent the fragmentation of activities between connected enterprises, also all operating within the same jurisdiction, where the aim is of those putting such structures in place to make sure all of those individual activities carried on by different enterprises fall within the preparatory and auxiliary exception. And this is done through the MLI, through an anti-fragmentation rule, which aggregates the activities of connected enterprises in deciding whether the exemption can apply. Again, it only applies if it's adopted in treaties by the relevant contracting states. And in this case, the UK has adopted this definition, and it's also extended its domestic law so that PEs can be created in circumstances where connected parties have together activities which breach the preparatory and auxiliary test. Now, recent experience shows also an increased willingness on the part of tax authorities to seek to treat subsidiaries as permanent establishments of other entities within the group. And there's a specific exclusion in the dependent agent rule, of course, from the PE definition, to the effect that subsidiary is not, just because of its own existence, a dependent agent of another entity within the group. But the changes to the definition of dependent agent and this anti-fragmentation rule increase the risk of one entity within a group being treated as a PE of another. Next slide, please. So finally, how do tax authorities find PEs? Well, they use all of the information sources that I've been talking about to open up inquiries. Now, the way in which they do that depends very much upon local practice, and the UK experience here is quite specific, because you don't see many individual permanent establishment inquiries being opened. If you go to the UK breakout session, you'll see my colleagues talking about diverted profits tax, and this is the way in which HMRC opens up a permanent establishment inquiry, because it opens up all the issues of profit allocation in one go. So there's diverted profits tax, yes, but also corporate residence, transfer pricing, permanent establishment allocation, all in one go, with HMRC friendly timing provisions, assessment provisions, and potentially no treaty protection in some circumstances, because it's regarded as an abuse type provision. That's where I'm going to finish. I'm going to hand on to Raoul, who's going to talk to us about all things Italian.
Hi, good afternoon, good morning, good evening, everybody. As was mentioned before, the Italian tax authorities have a long-standing tradition of attacking or assessing, auditing PE structures. Since the Philip Morris case, they started quite a big number of assessments to multinational groups in different industries and sectors. And depending on the case, of course, and the feature of the group and its functioning, the functions of the different entities and the activities, the overlapping of the activities, they have assessed from time to time agency structures or commissioner structures, so with agency PE, but also with facility PE, depending on the cases, as I said. One of the usual structure is to argue in favor of the existence of an agency PE of a foreign company, of a foreign group, before the premises of an Italian agency company of that may belong to the group or also be a third party, as I said. It's important to stress the factual elements that the tax authorities in audit practices have come up with, and always focusing on the activity of the person of the local agency company. So we have seen in many cases putting forward the fact that the personnel of the local agency company have margins of autonomy to determine the very essential elements of sale agreements or relevant contracts, and especially with reference to prices, fees, product quantities, the delivery times, the characteristics of the services, so with an important level of intrusivity in the management of the sales. Also, another very important factual point is the fact that the local people were regarded as the privileged interlocutor of the counterparties or of the clients during negotiation and also post-sale assistance. That's very important. Another very important factual point is the performance that was found or argued or assessed by the tax authorities of additional services beyond those covered by the master agency contract. So it was a very factual analysis and audit. And also, of course, it was always argued in favor of the existence of the substantial powers, so not just formal, of course, to conclude contracts binding the foreign parent. As I said, we have seen assessments on PE in different types of industries, manufacturing, new technologies, pharma, and also in the financial industries. There is a stream of audits, for instance, at the moment, on foreign insurance companies with respect to the placement of insurance policies in Italy through Italian brokers. So again, in this case, there were no Italian subsidiary companies of the group involved. There were third-party brokers that were regarded as, on the basis of factual elements, as the PE of the foreign company. And last point on the audit activities and what the tax authorities or the Italian tax police is doing, because the tax police is very much engaged in this type of audit. One of the most important aspects that they consider is the interviews to Italian clients and employees, analysis of the VAT Intrastat data, the access to emails or to the IT system of local people in Italy, clients or employees of the agency structure, and any documentation found at the premises of the Italian entities. I'll leave it to Joanne and
Fintan, if you want to join us.
Yeah. Hello. Hello, everyone. The next couple of slides are split between Olivier from Gide and from myself, and we're going to discuss a little bit about Ireland and France, and in particular, a couple of very interesting French cases which revolved around Irish companies with potentially having permanent establishments in France. But first, going back to the Irish view, is that the permanent establishment concept is no part of our domestic law. Ireland instead has a reasonably odd provision in its law that says that a foreign company only has a taxable presence in Ireland if it carries on a trade in Ireland, and a trade is sort of an active business, through a branch or agency. And the branch or agency concept links to our corporate filing obligation, which is to register a branch once you have effectively a permanent place of business open to the public in Ireland. So this differs very significantly from the permanent establishment rules. And so the Irish revenue don't often look for permanent establishments because it's not something they're used to in their domestic law. Also, the profit attribution rules, once you do have a branch or agency, differ again from the permanent establishment profit attribution rules. And this was highlighted in the Apple case, and a misunderstanding of the profit attribution rules led the EU Commission astray in that case, and probably led to the decision against the Commission in that case. And we'll discuss that more in the breakout room. If you do have, obviously, a branch or agency through which a trade is carried on in Ireland, a treaty can take you out of the charge to Irish tax, although that is quite unusual because the charge to Irish tax tends to be narrower than the treaty branch permanent establishment concept. Also, another feature is that Ireland does not have an exemption for branch activities if you're talking about an Irish resident company with a foreign branch. Instead, it taxes that activity typically at 12.5%. So an Irish company with a foreign branch would typically have sufficient foreign tax credit to offset Irish taxes. And indeed, you see many banks set up in Ireland or other insurance companies or other entities with many branches, some of which have very low foreign taxes on their profits, some are very high, and the two are all mixed. And typically, when you mix all the foreign tax credits together, you don't have any further Irish tax to pay. I guess the final point, and referring back to the domestic law concept and the expectations of Irish revenue, is that Ireland has entered into a full reservation in relation to Article 12 of the MLI. So we are not accepting the changes of the most recent OECD work in this area, but instead are trying to retain the old view of permanent establishment in our treaties, which again is somewhat similar to the domestic view, but the domestic view is then narrower. So at that point, we'll pass on to Olivier to give a sense of the French issues.
Yes, thank you, Fintan. Hello, everybody. So yes, indeed, the recent development here in France illustrates the importance of the PE risk. And to start with, I'd like to draw your attention to the fact that in France, we do have different views from Ireland, because France did not reserve Article 12 of MLI, and we follow a strict territorial approach. Over the last 10 years, we've seen quite a number of PE tax audits, and this is particularly true in an Irish-French context. Since the French tax authorities have launched aggressive tax audit against Irish belonging to Irish company belonging to US group, with search and seizures of French premises, international administrative exchange of information, claiming that the French subsidiaries of those groups that was providing marketing services to the Irish company, which itself was providing digital services, was constituting a dependent agent PE in France of the Irish company. This is especially important in the context of digital activities that raise many questions in many countries, including here. It is important to note that when developing these challenges, the French tax authorities are free to choose the basis of on which a challenge, either on a transfer pricing basis or on a permanent establishment basis. And in fact, if you consider that the subsidiary here is remunerated at arm's length, that should end up with the same tax basis. But the difference, and the reason why in both cases, Google and Conversant, the French tax authorities choose to reassess on the basis of dependent agent payee, that give them access to a longer statute of limitations, that higher penalty rate, and that also give them access to a strong leverage on criminal prosecution. In both cases, Google and Conversant, the facts are similar. The Irish co is providing digital services, and it has there is a French company within the same group that exclusively act for the Irish company and that provide marketing services, contact the clients, negotiate the contract using the templates provided by the Irish company, following the commercial and pricing policy developed by the Irish company, and send those contracts to the Irish company that routinely sign them through a digital process. In both cases, the Court of Appeal followed quite a legalistic reasoning and considered that in as much as the French company was not itself signing the agreement, or committing the Irish company. It was not constituting a dependent agent, and therefore upheld the position of the French tax authorities. In Google, the company was facing criminal prosecutions for tax evasion, and the Minister of Finance brought the decision of the Court of Appeal before the Supreme Court, and Google therefore decided to agree on a non-prosecution agreement, whereby it accepted to pay 1 billion, in fact, half as a fine and half as a tax reassessment. And in as much as it was at the same time litigating on the PE basis before the Supreme Court, they settled on a transfer pricing ground, and that closed the case. Conversant did not follow the same line, and the case was brought before the Supreme Court that held very recently, on December the 11th, decisions in which he considered that, the Supreme Court considered that even though the transactions are not formally concluded by the French entity in the name of the Irish company, since the French entity decides in a usual manner on transactions relating to the Irish company's activities, that the Irish company merely limits itself to endorsing on a routine basis, and which, when so endorsed by the Irish company, it constitutes a dependent agent PE. Therefore, the tax authorities won that case, and it is interesting to know that even if the double tax treaty between France and Ireland dates 1968, the plasticity of the concept of PE shown in this case result from the fact that the Supreme Court for the first time accepted to refer to the recent commentary of the OECD model dating 2005 and 2003, considering that even if they were not expressly indicating the intent of both states at the time of signing, they had a persuasive nature, confirming the reasoning of the Supreme Court, and that also led them to not to draw any consequences from the reservation made by Ireland on Article 12 of the MLI, since they consider that the concept of PE, which is contained in this whole treaty, in itself implies the existence of a dependent agent in the case where the foreign company routinely approves contracts that are generated in France by the French side. I understand that in Ireland, the settlement signed by Google allowed it to credit the tax part of the payment. In Conversant, the case is referred back to the court, which will have to determine the tax basis.
And so, with that background, how would you plan your operations? So the first thing you have to decide is whether you want to admit to a permanent establishment or to retain a position that you don't have one. To be able to make that determination, you clearly have to look at your operation. So you have to look at your employees, not just number, but seniority. We've also had an example where the Spanish tax authority asked for the salary numbers and the payroll slips of all the Irish employees to compare them to the Spanish employees in that case. How do you make decisions? Is it credible that really the decisions are not made locally, but the decisions are deferred back to the head office in Ireland in this example? Google probably had a better factual basis than Conversant, simply due to size and the level of seniority back in Dublin. Is the business of the French operation different from the business of the Irish operation? If it's not, if it's the same, then you probably have a higher risk of a local PE than if you had a fundamentally different business happening in the foreign country. So suppose you do that analysis and you conclude, well, we do have a permanent establishment. What do you do? Well, first thing you have to do is focus on your transfer pricing. How much profit are you going to allocate to the permanent establishment? And that will obviously dictate the level of taxation. Secondly, you need to implement to support that transfer pricing allocation. The tax authority is unlikely to argue that you don't have a permanent establishment, but you have to then implement it to make sure your transfer pricing is supported. And you document your processes, which of course documenting your process is a double-edged sword, because if you follow it, that's great, but life is often messy and sometimes you just don't follow the precise process, and that can become something that the local revenue authority will draw to your attention and conclude that you're doing something different. You clearly fully file and pay your taxes matching your position. And then question, in order to, in the case of Ireland, take credit for the taxes locally, do you file for an advanced pricing agreement? And I'll pass back to Olivier now to talk about if you don't have a PE.
Yeah, if you don't have PE, I mean, in fact, what I'd like to stress is that generally it is much better to take a transfer pricing risk than a permanent establishment risk. And I think this is true, at least here, from the standpoint of reputational risk, criminal prosecution risk, and financial risk. Has a PE risk give access to the tax authorities to longer statute of limitations, higher penalty, which make access to dispute resolution mechanism more complex when it is still available. So, and this is even more true if you consider a group with a local subsidiary treated as a dependent agent PE, since if you follow the arm's length principle, the challenge should not lead to an increased tax basis, but a change of taxpayer. And so that leads us to be extremely cautious when dealing with that risk, and check that the settings are robust and that the factual document patterns are in line with the contractual documentations. It is also key to comply with non-French tax systems, as in fact this is also a means to plead bona fide and access to lower or avoid penalty and shorter statute limitation. In practice, when there are ambiguities, it is important to keep in mind that, at least here in France, you can have access to a specific ruling to confirm the fact that you do not have a PE, which within 3 months is a way to get certainty. And also something which is important to have in mind is that we do have specific spontaneous regularization process, which allows to disclose hidden PE, hidden activities, and benefit from reduced penalties. In that respect, and to conclude, I think it is generally better whenever you have ambiguity to recognize the existence of a PE and draw consequences of that in order to switch from a PE risk to a transfer pricing risk.
Raúl, if you want to conclude this first session, part of the session.
Sure. Thank you. As Olivier and other colleagues were saying, the plasticity of the PE concept, plus other factors, the criminal and everything, leads to consider it is much better to take a transfer pricing risk than a permanent establishment risk. Of course, the two aspects are very much linked, and why, for instance, in Italy, but also in other jurisdictions in France, the PE risk is so tough to bear because of the criminal. Also, criminal procedure is really moving along together with the tax audit, and what happens in Italy is that the criminal charge is so easily triggered. For instance, in all the cases where the PE is not declared, so you think you don't have a PE, but the tax authorities or the tax police is arguing in favor of the existence of the PE. Then in all the cases where the tax not paid is higher than 50,000 euros, so it's a very little threshold, then the tax violation, which is administrative, becomes a criminal. And the issue here is that the criminal goes one way, the tax goes in a parallel way somehow. They don't communicate formally, so it's of utmost importance to coordinate the two in the defense, and especially in the audit phase. Otherwise, there could be cases where the criminal goes too quick compared to the tax, and maybe even a tax settlement during the audit phase is not able to stop the criminal side, which is personal, by the way, on the foreign individual that is legal representative or the signatory of the tax return that should have been filed for the PE, but that was not, of course. So what about the tentative domestic settlement scenario? First of all, as we said, it's the non-existence of a permanent establishment. So you have to argue that there was no fixed base, no through, no agency PE, no disposal, the usual stuff. Another alternative is to focus on intra-group dealings between the foreign company and the Italian distributor agent, if any, of course. The applicable penalties, and this is why also the transfer pricing aspects are extremely important, and to show, basically, you need to pay special attention to all these cases in the drafting of the TP documentation in order to support the non-existence of a PE, of course. So everything needs to be coordinated again, and this is very important. When you settle from a tax perspective in Italy, there is a very high probability of the dismissal of the criminal case. Even if this cannot be taken for granted, but in the vast majority of the cases, this happens. So this is why also these assessments are so tricky, because with the criminal threat, they push you to leave on the table more money to settle. Another very important part in this tentative domestic scenario is the filing of a unilateral or even better bilateral APA. We will talk about that in the different breakout sessions. Another very important aspect to consider is also the new dispute resolution mechanisms under the directive on cross-border disputes, the 17/1852, which could be very relevant in audit, but only for tax periods commencing on or after the 1st of January 2018. Let me stress that PE issues are covered within the scope of application of this new directive, and for instance, from an Italian perspective, and different from mutual agreement procedure under the tax treaty or the arbitration convention, the initiation of a MAP under this new directive would not be precluded in case of domestic tax settlement. We will see it in the break session that this could be extremely important in practical terms. Thank you.
Thank you, Raul, Fintan, Ashley, Olivier. I think you've done a great session. I really enjoyed it very much. Thank you. It was very interesting. You've addressed a complicated and sophisticated topic in a clear and didactic manner. So congratulations.